Hey everybody, welcome back to Matt Money. So, it's your boy, Uncle Matt. We're going to be talking about how much money I make from about a $475,000 portfolio, whether some of that is specifically in stocks, some of that is in kind of private real estate investment trusts, and then part of it comes from fundrise as well. So, we'll kind of break all that down for you guys. But before we hop into it specifically, I know you guys might have seen a sneak peek of what I was just sharing, but I want to show you guys a little bit of what we've been doing on passiveincomeeducator.com. We released a subscription based sort of service, $2 a month, where you get access to a multitude of different things like all of our specific courses, our Discord chat, and a bunch of different rewards. So, to give you guys an idea what kind of rewards you'll be getting potentially a monthly giveaway, whether that's cash, gift cards, or any sort of tools that we might be wanting to provide you guys. 30% off tutoring sessions and 50% off all Chartmaster tools. So if you guys are interested in buying the Chartmaster tool, you'd immediately get yourself another $6-7 free just off of that, which you could potentially pay for your 3-month subscription just for that. Now, of course, with the Discord, hopping right into it really quick, we have a bunch of different people talking in on it. We got Kyle, who's King of the North, passive income investor, if you guys are interested in chatting it up with him. But we talk about anything from general to RioCan if you guys are from Canada and you're in the RioCan clan, and also a little bit about options and stuff like that. So we're just getting it kicked off at the moment, relatively light on the amount of people in here, but we're still trying to move over some folks from our WhatsApp group into here and getting it kicked off. So if you're interested in joining and having a different avenue where you can ask me or Kyle questions at any given time of the day, feel free to reach out and subscribe through passiveincomeeducator.com. Now, getting into how much dividends I make from this particular portfolio. So as you guys can see, I'll probably scroll into the upper left-hand part where you're kind of seeing we have about $330,000 in the dividend portfolio and about $144,000. Actually, it's a little bit more than that now, but whatever. In the 401k. So we've had a couple good days in the 401k, and I just haven't checked it over the past couple days, and that's not automated like the dividend portfolio. So you can see in the nice little table that we have here, everything kind of split up by income and by value. And on the way right of the table, you can see the yield by sector. So you can see it ranges anywhere between like 0.23% for information technology, all the way up to close to 8% for things like energy. So that's like your Exxons, your BPs, and your Royal Dutch Shells. But you can also see what the percentage of the portfolio is by income if you kind of look in these two columns here, and by value. And so you can see that unfortunately when I kind of refer to this $15,000 a year in annual dividend income, it's really only referring to the dividend portfolio. Now, what I have thought about doing with this $144,000 is that I can actually roll that over to a Roth IRA or a traditional IRA, because not all of it is in Roth contributions, and actually being able to understand and figure out where all my dividends are coming from. But otherwise, at the moment, I'm kind of just left to like assume that it's going to be 1.5 to 2% based off the fact that I invest mostly in the S&P 500 in the 401k. So that being said, it ranges anywhere between 1.5 to 2%. So that being said, it's maybe $2,500 to $3,000 worth of dividends. So this 15 would go to 17 or 18,000. So give me another couple $100 a month in dividend income. But because of right now I can't see it, I'm not going to show it and falsify some sort of information for you guys. Overall portfolio yield on cost is about 4.7%. Dividend yield at the moment is about 4.5%. And that's obviously from investing in all these different particular things. It's being dragged down by things like ETFs, cash on hand, the information technology investments, industrials investments, and consumer discretionary investments as well. While that's a really small chunk, it does make up for a bit of it. So scrolling over to the right hand side of things, where you can kind of see it in pie graph form, these two tables or pie charts on the upper part is the same thing. The income is on the left, just like it was in the table, and the capital allocation is on the right by sector. So starting off with the capital allocation by sector in the upper right hand corner, you can kind of see that energy, financials, and real estate really dominate. They take up about 50% of the entire portfolio just from these things. So energy, you guys know, I'm a petroleum engineer by background. So that being said, I guess I'm comfortable with investing in energy stocks, but also it's been a lot smaller just based off the fact that energy stocks have taken a huge hit over the course of the last 6 months or so. So that being said, if this were to actually go back into being, I guess, normalized and kind of fit in with what financials are kind of priced in as, which is not necessarily as down as energy stocks, but also not really highly as valuated as tech stocks, kind of back in the middle, I'd say that 15 to 20% down range, I would assume that this would kind of come back into the 20-25% range. So more of like a normal valuation compared to where it is, because I have a lot of capital invested into energy right now, and you can tell a lot by the dividends that are kind of coming out on this particular edge as well. Moving into financials, about 20%. Real estate's about 16.5%. Healthcare is about 8%. Industrials is about 9%. Information technologies is just under 5%. Materials is just under or just over 3%. Telecommunications is about 5.3%. Utilities is small but growing at 0.9%. Continue to invest in my Southern company and Aqua America, or what's now called Essential Utilities, every month now. Then we have about 6% in cash, and then 1.3% in ETFs. I want to grow this ETF pie, or piece of the pie, just because I think that investing in something like QQQ and ITOT will be great for the long term. So this is relatively new. I did have some previous ETFs, but at the same time, I think that growing ITOT and QQQ will probably be the best. So I think I'm going to take a step back a little bit from funding the rest of this 98% of the pie and focus on this 2 to 3%. And that's not to say I'm just going to invest in random ETFs, right? It's going to be focused in hands-off total stock market funds and NASDAQ 100, and just kind of let it go. And because at the moment I don't necessarily need these dividends, and so we could talk about that in a little bit. But going into consumer staples, that's a little bit under 10%, and consumer discretionary is just over 2%. You can see that the income pie isn't too drastically different from that. There's obviously no consumer discretionary income, but there's consumer staples income of about 10%. Energy is just under 25% of the income coming from the portfolio. Financials is about just under 22. Real estate's just under 18. So these alone are close to 2/3 of the portfolio. And then if you include, meaning these alone, meaning energy, financials, and real estate, and if you also include consumer discretionary, you're probably looking close to 70%, maybe more. And then the remaining 30% is split between healthcare, industrials, materials, telecom, and cash. So obviously cash at the moment is not really paying a lot. You can see that the average yield based off of cash right now in the portfolio is about 1.1% and decreasing, because the Fed has now basically cut everything to 0%. So we did kind of level up at one point to about 2.2%. So the yield has actually come down by about 50% over the past, I would say, 7 months or so. So unfortunately that's kind of happening, because now I'm going to have to try to find other ways to try to get some more income, whether that's trying to use cash secured puts or something like that to try to buff up those yields coming from cash, because I want to make sure I keep the cash, but at the same time 1%, I mean, I'm losing to inflation at that point, you know what I mean? So especially with the interest rate kind of environment and the printing rate that we kind of have going on in the US right now. But let's see what else. So I guess for your guys' sake, just a quick rundown of how the portfolio is split up. So on the table here to the left, you can kind of see again the 401k, individual brokerage account, Roth, M1 Finance. Those are the majority of the funds here. You can see I have some money in the personal savings, about 4% of the portfolio in terms of that. And then I do have some cash elsewhere. About 3% in Cardone Capital. It's about a $15,000 investment. And we do have some cash in some other shares and stuff like that. But I would say the majority of the investment, about 80% of the investment, is in my fidelity accounts that I generally talk about most of the time. And majority of what I talk about is within the IBA and the Roth IRA. I don't so much talk about the 401k just because it's either S&P 500 or cash in the account. And that being said, I do have a lot more cash on hand because I do have a decent amount of my 401k in cash as well. So while it is this 144,000, not all of that's in the S&P. It's probably about 50-50 cash S&P 500 because I did mention I was going to try to roll some of that over to individual retirement accounts and kind of not being in a 401k anymore. But as you can see, the income, there's 0% coming from the 401k, about $1,000 a month coming from the individual brokerage account. We're closing in on that. About $200 a month. We're closing in on $200 a month from the Roth IRA. Computer shares, we have about $1,000 a year. M1 Finance, about 220 bucks, and that's continuing to grow as we continue to invest in that. Cardone Capital is about 675 a month. The shares that I get from work is about 672. Personal savings or my investment accounts is about 212 as well. So um, so far looking so good for a total of just under 15,000 or just under $1,250 a month on average. So like I said, the majority of the money is coming from this individual brokerage account. About 65% of it is coming from this individual brokerage account. So far in that respect, it's looking pretty good. And then, I mean, if you wanted to look at it in pie chart form, here you kind of go. 401k in terms of value, IBA is, almost a huge chunk of it, 40%. Roth IRA in this sort of chunk, and then the remaining 20% or so. So that's really where the money is coming from. Now, I don't really want to go too much in depth with respect to what's in each individual position. What I've kind of decided to do to kind of go a little bit more deeper is kind of pull a Gen X. You know what I mean? I'm going to figure out as of today what my top 10 kind of stocks are in terms of actual value in the portfolio. So I'm not going to do invested capital because then that would just basically just be all energy stocks. But what I am going to do is current value as of today. So there are some stocks that have close to $18,000 worth of value in the portfolio at the moment, and then it probably trickles down to about $10,000 of value in the top 10. So there is a bunch with like $7,000 to $8,000, $9,000 in each individual position. So because we are close to about 40-50 positions at this point. So that being said, I will only do stocks, so I won't do things like Cardone Capital or Fundrise or anything like that. So you guys can look forward to that. So if you guys want, over the next couple of weeks, I'll probably be releasing that. So make sure you hit the subscribe button. And I'm probably not going to do as good of a job as Gen X because that's not really the point, is to kind of dive as deep into what he's kind of looking at. I mean, that's like a different sort of level of video that I generally don't do because I do a lot of these videos off the cuff, kind of like what I'm doing right now. And I don't have the capability to deliver those kind of off the cuff as I would want to. So it's just not my style of video. But what I will tell you in those videos is why I invest in that kind of company, where I think that company fits in my portfolio right now, and would I be continuing to add to that sort of company. So if that's something that you're interested in, make sure to follow along with us in the future. And that would probably just be done by looking at this sort of template. Maybe I'll organize a little bit more because I can move these columns around if I want to with relative ease. So, but anyway, going into more of the forecasting and received aspect of the portfolio, just looking right now. So the goal for 2020, for those of you guys that have been following along, was to get to about $14,000 in dividend income in 2020. And so we took a huge hit from Royal Dutch Shell earlier. So I did have a decent amount of shares in Royal Dutch Shell, and that alone impacted I think my yearly income by like $400 or $500 a year. And so I'm not upset. I didn't sell Shell. I think it's a great long-term hold, and I actually added to Shell recently. But that being said, it did take an impact to my full year 2020 expected income, because I had about three more quarters worth of Shell dividends that I was expecting, and each one of them was over $100. So that was a huge impact. So I'm really trying to catch up to that. I would much rather not meet my $14,000 goal for 2020 than to say invest in something that's yielding 15% that I think is a not secure dividend. So while my yield is around 4 to 4.5% at the moment for all my stocks, I'm not going to go out and really get that really risky dividend and really try to just meet my target just for the sake of meeting the target. I want to make sure that what I'm investing in is high quality stocks and what I consider within my risk tolerance. And I would say the majority of the companies that are yielding over 10% are not really within my risk tolerance. You can see next year, 2021, we're forecasting that 14,955, just like I showed you on the overview tab. So next year, I think we're aiming for 21,000. So a big jump from where we are today. So about a $6,000 jump from where we are today. So compared to where we are, what is that? 6,000. I'm not good with math. So 21,000 divided by 15, let's just say. So we got to go up 40% from where we are today. So I don't think that that's going to be difficult. We have about, let's just say, $6,000 we're going to invest from just reinvesting these dividends, and then plus whatever dividend growth that we were expecting. Fingers crossed we don't have any more dividend cuts, because that will definitely put a hamper on things. But we're also going to continue to throw capital contributions into this bad boy to really try to beef up these numbers and make sure everything's all looking good. But you can see in 2020, these are the kind of dividends that we're kind of looking at. So just specifically kind of rolling through: 754 for January, 831 for February, 1410 for March, which is a great month. 748 for April, 859 was last month. This month we're hoping to get to that 1750 mark, but hopefully out of nowhere we'll maybe get to 1800. I don't really know how, just from dividends, but fingers crossed that somehow we screwed up the spreadsheet somehow and are losing $40. I would love to hit 1400 or 1800 in dividend income. And then you can see in September we get close to that 1900 mark. So hopefully with continued contributions we could probably get that closer to 2000. Fingers crossed. So 3 months away to kind of hitting 3000. That would be phenomenal. And then it kind of jumps back down just based off the fact that in December time frame we don't have some of the semi-annual dividend payments like we do from BHP that get paid in March and September time frame. But yeah, you can see we're already up from a lot of these months going into 2021. So things are looking pretty good. And some of these months here in 2020, we were already over 80 to 100%. And that just goes off the fact that we're just continuing to reinvest the dividends. We're continuing to throw more capital in. We're continuing to de-risking the portfolio as we get bigger. But that being said, I don't necessarily know what's going to happen with the dividend income from the portfolio. And what I mean by that is kind of just looking back here, you can see that the passive income sources, or not dividend income sources, but other passive income sources are continuing to grow from the portfolio. So you can see Shopify starting to be a contributor to the portfolio. YouTube also is continuing to be a contributor to the portfolio. And so at the moment, this is looking at about $4,300 of additional income. So at the moment, looking at about a third of what we're getting at the moment from these dividends, right? So if you kind of look specifically at the dividends, we had about 4,600, and the YouTube and Shopify made about 4,300 up to end of May timeframe. So it's about 50-50. So going forward, I wouldn't be too surprised if we're able to kind of scale back a little bit from the actual amount that we're investing into the dividend portfolio, focus a little bit more time and maybe some capital into the websites in the future, and see if we can get that going as well. So that's just another way to look at it. I don't think that dividend investing for me is bad. I think it's a really consistent and long-term view, but at the same time, it's not the most growth. And so since I'm 29 and I'm going to be able to pull away at the moment close to 18,000 in income coming from these sort of sources, whether it's YouTube, Shopify, and dividends, it makes sense for me to kind of be okay, well, 18,000, not including the rest of the year estimates for, say, Shopify and YouTube, looking at close to, let's just say, 24,000 once the whole year kind of plays out, fingers crossed. That's close to $2,000 a month in income. I can live in most places in the world on 24,000 and be quite okay. And so that being said, I don't necessarily need to focus on accelerating the dividend income, because if I focus more time on, say, YouTube and Shopify, my returns might be greater. So that being said, I've kind of got to that point where I can live, right? I don't need to be, I guess, begging for money on the streets or anything like that. And I guess I could say my backup plan is kind of fulfilled, right? So I can get a little bit more risky with the portfolio. I've always been trying to get to that point where, if I were to get furloughed, if I were to get laid off, I would have the amount of income that I needed to be able to sustain myself. And now that I'm there, or close to it rather, I feel like I could take the foot off the gas on specifically dividends and get a little bit more risky and see if I can get a little bit more growth out of the portfolio. Because I am only 29. And so that being said, it's worth to kind of diversify. And if things get great with, say, YouTube and Shopify, it's just going to only turn out better for the dividend side of the portfolio. Not to say I'm going to try to leave my 9 to 5 or anything like that. I love what I do as a petroleum engineer by education. So, there's nothing that I would rather be doing right now from a 9 to 5 job perspective. But that being said, all this other income from YouTube, Shopify, and my 9 to 5 all contribute into the dividend portfolio. So if I'm able to accelerate or expand any one of those, it's really only going to help the dividends, right? So yeah, that's relatively it. I basically just wanted to finish this one thing that I've shared with you guys in the past, but I think some of you guys may not necessarily recognize. But let me hide some of these really quickly and really show you one specific thing that I want to share with you guys. And I think a lot of you guys that come to watch my video might get, I don't want to say discouraged, but I'm going to say discouraged because I can't think of a better word right now. But I want to show you guys that 7 years ago, I started at $0 in my dividend income portfolio. Granted, yes, I did graduate from college with a just under 6-figure job, and I've now grown that to over 6 figures. But that requires a lot of time, a lot of education, and a lot of, I guess, sacrifice to be able to do that. A lot of sacrifice by myself and my parents, so I appreciate them for being able to, give me the education I needed to be able to do this. But I want to share with you guys this 7 years ago. I started at $0 a year. And 2013, I made less than $1 in dividends. And the year after, I made 262. 2015, I made 1,100 or just under 1,200. And so these are more the numbers that you guys might be able to relate to, right? The $262 a year, the $1,100, $1,200 a year, the $2,000 a year. So when I'm talking about $2,000 months, you guys might be throwing your hands up in the air. But let's think about it. I was there 4 or 5 years ago. You know what I mean? It's not like we're talking 20, 30 years. And so what I'm trying to get after here in this particular scenario is I started at 2000, 5, 6 years ago. Now we're looking at 3,500, 5,600, right? I mean, it all kind of snowballs, right? It's just about what we've been talking about and what everyone's been talking about forever, right? The compound interest being the eighth wonder of the world. If you just put concentration into it, you put time into it, you stay consistent, you continue to feed it, you continue to put work into it, it's going to continue to grow to the point where, within 7 years, from 2013 to 2020, I've expanded the amount of dividends that I'm getting, drastically. I mean, if you're looking at a percentage rate, I mean, that's a huge percentage rate increase. If you're to look at it in total dollars, I increased it, let's just say $2,000 a year. I mean, granted, yes, it was smaller in the beginning and it's gotten much bigger now. But I mean, if you're able to just increase your dividend income by 20% a year over the next 20 years from where you are today, you're going to be looking a lot better than me, than I was, right? I mean, in the long term, right? I mean, if you're able to consistently get 20% a year, I'm looking to get close to 40 to 50%. Do I have the numbers in here? So here's the percentage year over year growth. 30,000% in year one, 350% in year two, 71% in year three, 73% in year four. Year 5 was 62. Year 6 was 57. Year 7 was 55. I don't know if I got messed up with year 7 or whatever, but I'm trying to get to 57% this year, and then hopefully get to 50% next year, and then 30% every year after. And so it's going to be huge percentage increases in the beginning, and I understand that. But even if you can just can try to get yourself to 20% increases a year, look how quickly this goes up. I mean, think about it. 30% of $21,000 is, I don't know, $6,300. So if you think about it, I mean, even if you're able to contribute, and once you get to 20,000 a year, and you're just able to contribute it, even get it to increase 10%, you know, the amount of increases you're going to get are just absolutely phenomenal, and it's going to be huge. And you know, even increasing this 30% over the next 5, 6, 7 years is going to get me close to $100,000 in dividends. And if I can kind of maintain this by increasing dividend reinvestment rate, and I'm able to continue to invest capital, and I'm able to do because invest Shopify and YouTube income, is just going to get even more wild from there. So hopefully that was inspiring. Hopefully that was, I mean, that was the goal of the video, was to kind of inspire folks and say, hey, you know, this is how much I'm getting from the portfolio. And if you're kind of consistent with it, you can kind of get to the same place if you're, you know, really trying over time. I mean, this isn't going to be something that happens overnight for majority of folks. There are going to be some lucky few that get out alive, and will be able to kind of make, you know, seven figures within a year or two, just based off of some really smart picks. But I think a lot of this has to be said is this can be done with time and diligence. And if I wanted to walk away from this right now, I mean, I could guarantee 8 to 10% dividend growth, probably, you know, behind my back, with my hands tied behind my back. And so if you think about it, you know, 14,000, 15,000 right now, and you were to just say, make it easy, say 10% a year, the dividend payments are going to go up by 1,500 a year, to start off with. So that's an extra $100 a month. I mean, just for doing nothing except, you know, getting dividend growth. Not to mention me reinvesting those dividends, I'd be able to get, you know, another probably $1,000, maybe a little bit less, $800 increase. So take the 1,500 that you're going to get from the 10% dividend increases plus the 800 from the reinvested dividends. Boom, you're going to walk away in 2021, 2022 with, you know, close to $16,000, $17,000 worth of dividend income, and I didn't even do anything except reinvest and let it kind of ride in time. So anyway, elongated video to tell you guys how much I'm kind of making off the portfolio. So hope you guys come with some good questions in the comment section. Make sure to check out Passive Income Educators. See what you can, what we have to offer you with the 1-year subscriptions, 3-month subscriptions, 6-month subscriptions in the description box below. And make sure you be able to check out our Discord, otherwise you won't be able to join. And that's relatively it for this video, guys. I'm just going to edit it up. I think that was a pretty good second or third take. I did mess up on the intro once or twice, but I think I didn't mess up enough where I have to redo the whole video. So just going to do some minor editing, cut out the first two couple introductions, and I'll see you guys in the next video. Cheers.